Hi everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video I'm going to be debriefing for you people the latest examiner report which is available to us. So this I am preparing on the 28th of February. So that means the latest examiner report happens to be September-December 24. So I have copy pasted the snips of the questions over here so that we can have everything in one place. So let's get started. The very first question that this examiner's report provides to us is Snow Company has in issue some 6% loan notes with a nominal value of $100 per loan note, redeemable at a 13% premium to their nominal value in 4 years' time. The required yield to maturity is expected to be 8% per year, and Snow Company currently pays tax at 20%. So you have to calculate the market value of each loan note, giving the answer to 2 decimal places. Now over here, the common mistake which the students make, here they're asking you about the market value. Market value, who trades and buys and sells in the market? It's the investors. Is it the company who gets the tax benefit or the investors? It's the company, right? So tax rate has nothing to do with the investors, hence it has nothing to do with the market value. So the only mistake that students usually make is with respect to this, that they would subtract the interest part from this 6% interest that they get. So on $100, the interest amount is going to be $6, and this $6 they are going to be getting from the first year till the fourth year. So 1 to 4, this is a recurring payment, so we are going to use the annuity factor. Annuity factor for 8% is the required rate of return for 4 years. So I've also copy pasted the tables over here, annuity as well as the present value tables. This is the annuity table. I'm looking for 8% for 4 years. So it's 3.312. This is 3.312, and then at the end, in the fourth year, I'm going to receive a one-off payment in which I'm going to get the redemption of the loan note, which is going to be at a 13% premium. So if the nominal value is 100, 13% of 100 is 13. That means at redemption I'm getting 113. So at redemption I'm getting 113, which will now we will take the discount factor because this is a one-off payment. So here I again open the present value table. 8%, fourth year it's 0.735. So 0.735, and what you're going to do is you're going to multiply 6 with this value, 113 with this value, and whatever is your answer will be the final answer of this question. So 6 into 3.312 plus 113 into 0.735, your final answer is going to be 102.93, which is going to lead you to option D as your correct answer. Let's head forward to question number 2. Question number 2 asks us, which two of the following are not money market instruments? Now always remember, there are two sorts of markets that we have. The two types of markets are money market and you have the capital market. Now when it comes to the money market, it's all about short-term instruments, and capital market deals with medium-term as well as long-term instruments. So here we are going to eliminate those options because we have to select which are not money market instruments. So any instruments which are for the medium term or the longer term can straight away be eliminated, which is going to be the answer because they will not be money market instruments, as money market only deals with the short-term instruments. So here bills of exchange is definitely traded in the money market. Commercial paper is also having a short duration. Preference shares, I find the first black sheep. This is the one which is going to be dealing with the capital markets because it's long term usually, right? Same goes for bankers acceptance. This is something which is used in the short term, which we have studied as a money market instrument also. And then the last one is irredeemable loan note. It says irredeemable, that means again it's a long term capital. So option C and E are going to be your final answers here. Moving forward to question number 3 now, Sunny Peaks Company has a current market cap of $42 million and they have recently paid a dividend of $7 million. So D0, because it's the recent dividend, D0 is going to be 7 million. Annual growth rate of dividend, G is given to us as 2%. And then you also have the market cap. Market cap is nothing but the price, market value of the shares. So market cap P0 is also given to us as $42 million. Now we have already learned in our concepts the formula of DVM. So DVM says your cost of capital, cost of equity will be D0 into 1 plus G. So you take, this is the formula that you have learned, D0 into 1 plus G. This needs to be divided by P0 and then you need to add the growth rate separately. This is the formula that you people have learned. Now the dividend is already given to us as $7 million. This will be multiplied with 1 plus 2%. Divide this by P0, which is given to you as 42, and then you have to add 2% to this value. So your final answer is going to come out to be 19%. So this is going to be your answer for the fourth question. Now moving to the fifth question of section A, which is given to us. Alright, so this question says, Sterim Company is a large pharmaceutical company listed on an internationally recognized stock exchange. The board intends to raise finance of $150 million in order to fund the development of a new product, but needs advice on how to best raise this amount of capital. You are supposed to tell them that which intermediary will be the best source of advice. So they are looking for advice, right? So we have to select the intermediary which will offer them advice. Now a discount house is somebody you go for to if you want to get your bills of exchange or any instruments discounted. So discount house are going to trade in investments like bills of exchange rather than advising you on corporate finance. So this is not going to be our answer. Then investment bank. What's the role of an investment bank? It gives you different services, different banking services to the clients, and they also give them advice for raising capital. So this can be our answer. Let's see if the others get eliminated. Unit trust. What does a unit trust do? Unit trust, basically these are institutions who invest in different sorts of shares, debentures, different sorts of securities so that they make returns. So they do not provide advice. Hence, because advice is what we need, we cannot possibly go to a unit trust. Then talking about clearing banks. Clearing banks are mainly those kind of banks which are giving you daily banking services like debit card, ATM, withdraw cash, deposit cash. So all of these are what clearing banks do. So again, this is also something that advice will not be offered by them. So who is going to offer the advice? It's going to be the investment bank. Let's move forward. You have another section B question that has been given to you by the examiner in this specific examiner report. Section C, I have already posted YouTube videos wherein I have debriefed those two section C questions step by step. So if you want to further get into the September-December 24 exam, you can refer to section C from there. Now coming back to this section B question, Grift Company. Let's read the scenario. Grift Company is based in a country whose currency is the dollar. So this is my home currency. Company has legal expenses in a foreign country, farmland, whose currency is the peso. Legal expenses of 26 million pesos must be paid within the next 6 months. So this is the amount of money that we are supposed to pay. This is a payment case over here. Okay, let's read further. Spot rates are given to us. 6-month forward exchange rate is given to us. Then it says the peso dollar exchange rate has been volatile and recently and the finance director of Grift Company is wondering whether a lead payment might be better than hedging the payment of legal expenses within a 6-month forward exchange contract. Now, Grift Company has bank loans in the foreign country with a nominal value of 5 million pesos that are split equally between the fixed rate and the variable rate debt. The company has no assets generating interest rate income. Finance director is concerned about the interest rate risk associated with these bank loans. Now, the very first question asks us, according to the exchange rate theory, which of the following could explain the current peso per $1 forward exchange rate of this? So basically, the forward exchange rate is also given to us at today. So we are supposed to explain why this is changing from this 6 months from later. So right now the spot rate, what you can see is To buy 1 US dollars, you need to pay 8 pesos. That means dollar is strong. To get only $1, somebody from Farnland will have to spend 8 of their pesos just to get that $1. So dollar is the stronger currency over here. Now what happens? The 6-month forward exchange rate is telling us that 6 months from now, $1 will cost them roughly 7.8. So that means earlier they were having to give 8, they were having to shell out 8 pesos. Now they have to give slightly lesser than that to get that same $1. So what does it imply? This implies that peso has strengthened. Why? Because to get that same $1, earlier you had to pay 8 pesos. Now you have to pay 7.8. So you have to pay lesser peso to get that same $1. So here we see that peso has strengthened. Now we have learnt as a part of our concepts, always and always, those currencies will depreciate where inflation or interest rates are higher. So for a stronger one, their currency in their country, interest rates as well as inflation rates will be lower compared to the other currency. So here we are talking about dollars and pesos. If pesos has strengthened, that means they will have lower inflation and they will have lower interest rates. So let's see which statement corresponds to that. First says peso inflation is higher than dollar inflation. This is something which we can straight away eliminate. If a currency is getting stronger, that means lower inflation, lower interest rates. Supply of dollars is expected to decrease in the near future. Now talking about the supply, I get reminded of the law of demand and supply. So the law of demand says whenever the demand for any specific good will increase, then the price will increase. So here dollar is actually decreasing, dollar is losing out, dollar is depreciating. So whenever you reduce the supply of something, whenever something becomes scarce, you are not able to buy that easily, what happens? The price goes up. So that means dollar should have strengthened if this was the case, which is not. So we eliminate option B also. Option C says peso interest rate is lower than the dollar interest rate. This is exactly what we have written over here. So option C is something that we can mark as the correct answer. What happens to the fourth statement? Fourth statement says government of Farnland has been selling pesos from its official reserves. Now selling pesos means you are supplying pesos in the foreign exchange market. Whenever you supply something too much, the supply becomes too much but the demand is not so much. So what happens? As a result, the price goes down. That means pesos should have depreciated. However, you see peso has rather strengthened. So this statement also implies the opposite. Hence you eliminate this option. Option C is the final answer. I hope this is clear. Moving forward to the second question relating to this scenario. So the second question says, which of the following statements about forecasting exchange rates is or are correct? So the first statement says international Fisher effect suggests that changes in exchange rates are matched by changes in real interest rates. This statement is totally true. Just one thing is there which makes it false. Instead of real, had it written nominal, then this statement would have been absolutely correct, because this is what we have learnt as a concept. International Fisher effect actually tells you that whatever changes there in the exchange rate, this is going to happen because of changes in the nominal interest rates. So here, because it says real interest rates, that makes the statement incorrect. Let's talk about the second one. Under purchasing power parity, changes in domestic inflation are balanced in the longer term by changes in exchange rates. Exactly, purchasing power parity takes care of inflation. The formula of PPP includes inflation in the calculation. Hence, this statement is absolutely correct. So, answer is going to be B2 only. Moving ahead to the next question. If Grift company decides to make a lead payment for the legal expenses rather than using a 6-month forward contract, what is the cost saving for the company? So as you can see, the pesos are strengthening. So that means we will have to pay more dollars if we exchange them in the future. So what has the director suggested? Director has suggested that you should go for a lead payment. Firstly, it's important to understand the concept of a lead payment. Lead payment means, the word lead means being a leader, being doing things first. So whenever, even though you're required to make the payment 6 months later, leading means you're making the payment earlier. So instead of making 6 months from now, we are making the payment today. So the question is asking us that what difference will it make to the company if the payment is made today rather than 6 months later. So what we are going to do is we are going to calculate the cost under both of the scenarios. So here we are on the payment side and we are supposed to make a payment of 26 million pesos. So the payment amount is 26 million. Now do we divide or do we multiply? How do we figure that out? We are going from pesos to dollars. So dollars is the stronger currency. For $1 you have to shell out 8 or 7 pesos. So that makes dollar stronger. So whenever you're converting pesos to dollars, dollars are going to be a lesser amount because dollar is stronger. So you're going to divide. Divide by what rate? Now you have two rates given to you on spot. So the dealer always takes the advantage. Here you are going to shell out dollars. So whatever option makes you shell out more dollars from your pocket is the rate which the dealer is going to be charging from you. So here, because we are dividing, so if you divide by a lesser amount, you will have to pay more number of dollars. So 8.0927 is the rate which the dealer will offer us today. So this is 8.0927. If we work this out numerically, 26 divided by 8.0927, this gives me 3212772. 3212772. This is the value that I'll have to pay if I make the payment today. Now what happens to my cost if I pay this after 6 months? So if I pay this after 6 months, I'm going to use a forward contract. So let's see what the forward rate is being offered. Again, we are going to take the lesser rate, 7.8534. So 26 million divided by 7.8534. Let me plot this in my calculator real quick. 26 divided by 7.8534. This gives me 3310668. 3310668. So do you see, if we pay today, this is the spot rate and this is the rate according to the forward. So if I enter into a forward contract, my payment happens to be more. That means I can save money if I make the payment today itself. So how much do I save? You can simply calculate the difference between 3310668 minus 3212772. So if you run this number on your calculator, it's going to give you 97896. So this is going to be the final answer that you plot in over here. Okay, let me move to the next question now. Which of the following statements about interest rate risk is or are correct? So the first statement says negative gap exposure means that for a given maturity date, interest sensitive liabilities are less than interest sensitive assets. So the way to remember the gap exposure is very simple. If you have assets more than liabilities, it's a positive gap. And if you have liabilities are more than assets, then you have a negative gap. Let's read the statement again. Interest sensitive liabilities are less. No, liabilities are more in the negative case. So this makes this statement incorrect. Second statement says bank loans of gift company give rise to a basis risk. Now this statement is also not correct because basis risk would be there if the different variable interest rate assets and different variable interest rate liabilities have a different basis. So we have learnt in our concepts, I hope you people have also learnt, I have taught my students the same. So whenever it comes to basis risk, the concept says You have different sorts of bases on which interest sensitive assets and liabilities can be based on. You have different bases. You have the LIBOR, London Interbank Offer Rate. Then you have a rate called as SONIA. Then you have a rate called as SOFR. So these are the sterling overnight financing rate. So these are a few bases on which you will usually find interest sensitive assets and liabilities to be based on. So basis risk arises when, let's suppose my interest sensitive assets are based on LIBOR, and let's suppose at the same time my interest sensitive liabilities are maybe based on SONIA. So because they are both linked on different bases, we call this as basis risk. So here no sort of information is given to us that the basis is different with respect to the interest sensitive assets and liabilities. Hence, we are going to mark this statement also as incorrect. So our answer is going to be neither 1 nor 2. Now moving ahead to the very last question of this examiner report. Just give me a moment. Okay. So here is the very last question. This question asks you, which of the following statements about interest rate derivatives is correct? So the first statement says a swap which exchanges fixed rate and variable rate interest in the same currency should give benefit to both counterparties. Obviously, yes. Why will people swap the things amongst themselves? Is because one person will have what they wanted but could not get, while the other person has exactly what they wanted but could not get. So basically, my want is satisfied by somebody else. Somebody else want is satisfied by me. So that will benefit obviously both of the parties. So hence statement A has to be true. Let's see why statement B, C, D are incorrect. Statement B says interest rate future contracts protect a borrower from interest rate increase while allowing the benefit of a lower interest rate to be obtained. With futures, it is a binding agreement. You do not have a choice. It is with options that you would rather have the choice. So this statement is marked incorrect. If even if the interest is lower, whatever you have locked in the futures, that is what you will have to eventually pay off. Then let's come to the third statement. An interest rate collar is created by selling a cap and selling a floor. This statement is the opposite. Whenever you want to go for a collar, collars are created when you buy a cap and sell a floor. So how do you create a collar? You buy a cap and you sell a floor. So here it also says sell cap, that is why this is incorrect. Statement D says over the counter interest rate options. OTC means something which is standardized for you, which is custom made for you. Have standardized quarterly settlement dates? No. If it's made custom for you, it will have an expiry also according to your need, according to your liking. It is the exchange traded interest rate options which will have a standardized quarterly settlement date. So this was the discussion for the December 24 examiner report. I hope that you people found this video helpful. Do let me know if you want me to create something similar for the previous most recent examiner reports also. Thank you for watching. All the very best for your exam.